Things move quickly, things break. At what point do you start to see market functioning break down in a way that catches the Fed's attention and beyond?
Yeah, market functioning, again, particularly in treasuries and in credit, and the fact that it's spread to investment grade credit is definitely a yellow flag. This is one of the reasons the Fed brought its balance sheet to bear in March of 2020. It wasn't just to backstop those markets, but to add liquidity. And I think it's a really unhealthy sign that it's happening this early in the tightening process.
Well, it is early in the tightening process. It frankly has barely begun, Eddie, yet we've already seen these markets move so far. We're looking at a 10-year Treasury yield that is north of 3.3%. At what point do we actually see yields moving lower because of the Havian bid, because of growth concerns, rather than higher on expectations of higher Fed rates?
That's the critical question, because so far we've seen the repricing of the Fed tightening cycle being brought forward. A steeper, faster tightening cycle translate into essentially a parallel move in the curve higher. I think that dynamic was very difficult to sustain when you have risk markets getting weaker. I think there will be a point at which we're seeing right now the curve start to invert, but that inversion will become more aggressive and we'll actually get outright bid for the long end of the Treasury curve. When that happens is a critical question. I think what we're searching for here as market participants is really the level of neutral. Once the Fed is priced to go above the level of neutral, historically the safe haven bid returns to the long end. Clearly, we're not quite there yet.